Global chip stocks have shed $3.3 trillion in value since late June. And this week, the sector everyone's been calling the whole market's collateral finally, officially tipped into a bear market. Good morning, it's Saturday, July 18th. I'm Nit Vertucci with Eleanor Whitfield and Marcus Brooks. This is the weekend edition, The Week Graded. No preview today, no what to watch, Monday until the very end. We're laying the whole week on the table and grading it, ourselves included.
My favorite part of the week.
It is not her favorite part.
4 threads. The semiconductor rout that ate the AI trade's own good news. An oil shock out of the Strait of Hormuz that turned a toll booth into an actual argument. A bank earnings season that somehow made beating estimates look risky. And an inflation story that got completely run over by the other 3. Plus the scoreboard, which is where we start now every Saturday. Where do we stand walking in, Eleanor?
4 wins, 3 losses coming in. Streak of +2.
Marcus.
3 and 6, streaks -2. And there's a live one from yesterday I already know isn't going to help.
2 of them, actually. Let's close both before we grade anything else. Eleanor, you had Brent crude closing above $86 yesterday.
I did, and I want the exact number before anyone tries to be nice about it.
$85.95.
5 cents. I lose a specific, checkable call by 5 cents.
That has to be the closest loss in the show's history.
It doesn't get partial credit for closeness. I said above 86. It closed below 86. That's a loss. I'm not going to lawyer a nickel.
Appreciate it. Marcus, yours was cleaner, unfortunately for you. SOXX closes green yesterday.
Down 1.64%. Green did not happen.
That's twice in 2 days and almost the same bet.
I'm aware. I made the same trade Thursday, lost it, and then got up Friday morning and made it again with more conviction, which in hindsight is not a great use of the word conviction.
It's a stubborn use of the word conviction.
So here's where the season sits walking into next week. Eleanor, 4 wins, 4 losses, streak resets to -1.
Noted. Least favorite part of my favorite part.
Marcus, 3 and 7. Streak stretches to -3.
3 and 7 is not a number I enjoy saying out loud.
Sarah and Dave sat this week out entirely. Still 0 and 1 apiece. Streak of -1 each, untouched since Sarah's Brent call 2 weeks back.
They're not even here to defend themselves.
That's the whole point of an empty chair.
Now the part I actually want to spend real time on, call of the week and miss of the week. Marcus, you've got both, which is either impressive or embarrassing depending on the day.
Give me the good one first, please.
SK Hynix, Tuesday. Read the call back.
I said if it rallies through scary oil and geopolitical headlines and closes back above 160, that tells you the flush from Monday's 15% crash was flow, not fundamentals. It closed at 193.92, up 28% on the day. Erased the entire crash and then some.
The day before, the stock had just posted the worst single session in its history. Walk me through why calling the bounce mattered more than just getting the number right.
Because everyone else was still flinching. A Korean brokerage had cut its own second quarter estimate on an HBM4 shipment timing slip. The Kospi had a trading halt. Micron sold off in sympathy. The whole tape was pricing a demand problem. I was betting it was a timing problem wearing a demand problem costume, and the flow proved it in one session.
I'll back the call even though I fought him on it live. What I said Tuesday was that a 28% pop with brand new leveraged single stock ETFs launching into it had the fingerprints of mechanical flow all over it, not investors calmly repricing an HBM franchise. I still believe that part.
And yet you're handing him the trophy.
Because the test we set together was whether it held. It gave back 9% Wednesday, which is exactly what Flow Not Fundamentals predicts. But it's still sitting well above where he called it, above the IPO pop after a second ugly overnight in Seoul. The call was right about the moment even if the mechanics under it are messier than a clean win.
Call of the week. Marcus, SK Hynix, betting the bottom on a stock that had just had the worst day of its life. Now, the harder half. Miss of the week is also yours, and I don't think you'll fight me on it.
I won't. It's XX Green, 2 days running.
Walk it through both days, because the story's actually better than just he lost twice.
Thursday I said the stocks would flip green by the close on a genuinely great TSMC number, and Nvidia specifically would close up on the day. Neither happened. The whole index finished down around 3%. Nvidia closed red. I was wrong in both directions at once. Then Friday, instead of taking the hint, I made almost the identical bet. SOXX closes green, and lost that one too, down another 1.64%.
What made you go back to the same well a second time?
Honestly, I thought 2 ugly sessions on a number that clean had to be an overreaction that corrects fast. I said it myself Friday morning. I was early yesterday. I don't think I'm wrong on the direction. Being early twice in a row on a falling knife just looks like being wrong.
I'll say this for him. He doesn't hedge the postmortem either time. Some hosts find a way to call a double loss a moral victory.
It's not a moral victory. It's 2 losses that happen to share a thesis. I still think the thesis survives. I just picked the 2 worst days of the year to bet on the timing of it.
Miss of the week, Marcus. SOXX, the bet he wouldn't let go of. Let's get into why that bet kept losing, because it's thread 1, and it's the story that actually defined the whole week. Eleanor, set the scene. How bad was the chip trade? In real numbers, not vibes.
The Philadelphia Semiconductor Index fell more than 9% this week alone, and is now down roughly 20% from its late June record. That's the official bear market line, and it crossed it Friday. The Van Eck Semiconductor ETF posted its 3rd weekly decline in 4 weeks. And globally, chip stocks have given back something like $3.3 trillion in market value since June 22nd.
Trillion with a T, on stocks that were mostly fine companies reporting mostly fine numbers.
That's what makes this week strange, and it's the paradox that actually kicked it off. Taiwan Semiconductor posted a genuinely historic quarter Wednesday night, 5th straight quarter of record profit. Revenue up 36%, gross margin 67.7%, and they raised full-year guidance instead of lowering it.
Every single line of that report was a beat, and the stock still fell about 4% and dragged Nvidia, AMD, Broadcom, and the memory names down with it.
So what actually spooked people if the quarter was that clean?
The bill that comes with it. TSMC raised its own 2026 capital spending guidance to $60 to $64 billion, up from $52 to $56, and their 3rd quarter margin guidance, 56.5% to 58.5%, sits below the 60.3% they just posted. The company itself is telling you margins already peaked for this cycle, right as the spending ramps higher.
Translate CapEx for someone who just hears a big number.
Money spent building factories and equipment today doesn't disappear. It gets depreciated, spread out as a cost over years to come. Spend more now, and you're committing to a bigger fixed bill in 27 and 28, whether or not AI demand is still there to pay for it by then.
Which I still think is the wrong lens. Respectfully, a company doesn't raise CapEx by $8 billion on a whim. They raise it because order books justify it. Hyperscalers are locking in multi-year capacity. That's a different animal from spending to chase a story.
I don't disagree the demand looks real today. I'm flagging that real today and still there in 28 when the depreciation bill comes due are 2 different claims, and the market spent this week pricing the second one more cautiously than the first.
And then, on top of a CapEx scare, an actual competitive shock landed.
Chinese startup Moonshot unveiled Kimi K3, an open-weight model the company says rivals the Frontier systems out of the West. Same playbook as the DeepSeek scare from last year. If Frontier capability can be replicated cheaper than the hyperscaler build-out assumes, the whole justification for the CapEx wall gets shakier.
And that's the piece that actually broke SOXX into bear market territory Friday, not TSMC's number by itself. AMD fell 5% to 477.81, Intel down 4 to 93.24, Nvidia off about 2 to 206.77, Broadcom down 2 to 366.51. The best supplier beat in years, and the group still couldn't buy a green session by Friday.
Give me the outside read, not just our own numbers.
A BofA strategist's bubble risk indicator is sitting at 0.91 right now, well above the Nasdaq 100's own 0.69, and more than one desk is drawing the comparison to June of 2000, right before the dot-com top. That's not our read, that's the streets, and it's getting louder.
I'd push back on the comparison itself though, not the number. .com was priced on revenue that didn't exist yet. This is priced on revenue that's showing up quarter after quarter from real hyperscaler capex that's already been spent. Overvalued and fictional aren't the same kind of expensive.
Give me the tell. What would actually make you concede Eleanor's version of this over yours?
If Nvidia keeps trading down on genuinely good supplier news for more than a couple more weeks, not just this one rough week off a historic run isn't a verdict. 3 or 4 in a row starts looking like one.
And SK Hynix, the stock that's been the whole week's fever chart in miniature, had its own gut punch Friday, separate from any of this.
South Korea's Kospi fell 6.6% overnight, its worst session in months, after the Bank of Korea delivered a surprise rate hike, its first since 2023, explicitly to get ahead of war-driven inflation. SK Hynix dropped more than 11% on it, Samsung over 8%.
A central bank hiking into a war instead of cutting is the opposite of what most of the world's doing right now. That's not an A-cape story at all. That's Hormuz reaching into a completely different part of the tape.
Which is a good hinge, because it wasn't just chips this week. 2 of the market's other favorite growth stories got the same treatment, for what sounds like the same underlying reason. Netflix and Alphabet.
Same sin, different stock, both after Thursday's bell. Netflix actually beat $12.56 billion in revenue, 80 cents a share against a 79-cent estimate. Clean beat on the quarter that already happened.
And it fell more than 8.5% anyway, down to around $68, a fresh 52-week low. Because the guide was soft, third quarter revenue guided to $12.86 billion against a street number closer to 13, and they're cutting their subscriber engagement disclosure down to an annual cadence starting 2027, which reads like they're hiding the trend line right when it's decelerating.
And Alphabet?
Down 4.4% the same session, over $200 billion of market cap gone, on a report that Gemini 3.5 Pro missed its third straight launch deadline, alongside a wave of senior DeepMind departures.
So tie it together for me. Chips, Netflix, Alphabet, 3 completely different businesses, same week, same reaction.
The through line is the market stopped rewarding "we beat the quarter that just happened" and started demanding proof the story compounds from here. TSMC's CapEx bill, Netflix's slowing guide, Alphabet's delayed model, none of those are current quarter misses. They're all forward-looking doubts, and this was the week investors stopped giving that doubt the benefit of it.
Which I'd still call healthy, not scary. A market that questions the payoff on $8 billion incremental CapEx dollars instead of just cheering the number is doing its job. I'd rather see this rotation now than a Netflix-style reckoning landing all at once in 2028.
We're going to leave that argument breathing, because I don't think you two are actually settled on it. Bubble-adjacent reprising, or a market doing exactly what it's supposed to. We'll pick it back up the next time a name reports. 30 seconds, because I owe you both an ending. My coffee saga, pot under the machine Wednesday, mopping it up Thursday and Friday.
Is it actually over?
It's over. I made a full pot this morning, no incident, pot exactly where it belongs.
A quiet Saturday victory. Micron would trade for that kind of week.
Low bar, but I'll allow it.
Back to the tape. Thread 2, oil, and the story that turned a shipping lane into the whole macro conversation this week. Eleanor, set the numbers first.
WTI crude rose 13.5% this week to 81.14, its best weekly run since late April. Brent closed Friday at 85.95, 5 cents from my call, as we've established after trading as high as the mid-80s most of the week on a 7th straight night of CENTCOM strikes tied to Iran.
And it's not a headline risk story anymore, it's a physical one. Traffic through the Strait of Hormuz collapsed from somewhere around 18 to 22 vessels a day earlier this month, down to single digits by Thursday and Friday. Outside trackers put Thursday at 8, down from 15 the day before. Roughly a fifth of the world's seaborne oil trade runs through that choke point.
Walk me through what we got from ceasefire to blockade this week specifically.
Tuesday, the naval blockade the U.S. had threatened went back into effect, 4 p.m. Eastern, covering Iran's entire coastline, plus a 20% toll on any cargo transiting without American authorization. The administration's framing it as a toll, not a closure. Trump's own words were that it's, quote, closed for Iran, both in and out, but open now for everyone else.
Except, open for everyone else hasn't matched the tanker count. At least 9 ships have come under attack since July 6th by outside reporting, including an Iranian cruise missile hitting a UAE tanker in Omani waters that killed a crew member. One maritime risk executive put it plainly this week: worst-case scenario for tankers in that strait.
And yet oil didn't spike to triple digits, which is the part that doesn't fit a clean supply shock story.
That's exactly where Marcus and I split, and I don't think either of us is backing off it. My read: Brent sitting in the mid-80s instead of triple digits isn't the market shrugging this off. It's the market not having caught up yet. 6 vessels tracked crossing in 2 days, against 18 to 22 earlier this month, is an 80% a plus collapse in traffic through a strait that carries a fifth of global oil flow. If that holds even one more week, mid-80s doesn't hold with it.
And my side is that a toll is a price, not a wall. If shippers can pay 20% and keep sailing, that's a cost that gets passed through to buyers, not a supply cut. And Bloomberg reported 6 U.S. sanctioned supertankers, 12 million barrels combined, slipped through with their transponders switched off in just the past week. The oil's finding a way through, quietly, but it's moving. Brent staying in the mid-80s instead of spiking is the market pricing that it gets absorbed, not that it's asleep at the wheel.
6 tankers moving dark isn't the same as normal flow resuming. That's evasion, not commerce. At that magnitude, most of the fleet isn't finding a way through. It's sitting still or rerouting around Africa.
You two didn't resolve this on Friday's show, and I don't think you're going to resolve it on mine either, so I'm going to do what we did then: name the split and leave it. If the tanker count climbs back toward the teens next week as shippers adjust to the toll, Marcus is right and this stays a cost story. If it stays in single digits, Eleanor's right and we're testing triple digits before the month's out. Watch the vessel count, not just the Brent print.
I can live with that as the test, same as I said Friday.
Same.
One more piece, because it's the strangest chart of the week and almost nobody's talking about it. Commodities didn't all move the same direction.
Gold actually slid toward $4,000 an ounce even as oil climbed, which is usually the opposite of how a Middle East scare trades. The move higher in oil reinforced a stickier inflation, less room to cut story for the Fed, which pushed real yields up and pulled gold down. A stagflation-flavored read, not a clean flight to quality one.
Copper told a totally separate story underneath both of those, up about 1% on the week, 16% over the past year, and that's got nothing to do with the Middle East. That's a 15% tariff on refined copper imports reportedly starting January 2027, with inventory stockpiling at a record pace ahead of it.
And natural gas did the opposite of oil entirely. Henry Hub near a 2-month low because domestic output's up and Freeport LNG's export terminal is offline for maintenance, bottling up supply at home.
So 4 commodities, 4 completely different stories in the same 5 days.
Which is the actual lesson. If there's one lesson from this week, stop treating commodities as one trade. Oil's geopolitical, gold's a rate story wearing a safe haven costume, copper's a tariff story, gas is domestic plumbing. They only look correlated when a headline's loud enough to blur them together.
Thread 3 bank earnings. Because this was supposed to be the week that gave the tape something boring and reassuring, and it did the opposite in at least 2 cases. Marcus, start with the headline.
Goldman Sachs posted the best quarter in the firm's 157-year history, $20.98 a share, a 45% beat, net revenue up 39% to $20,030,040, investment banking fees up 55%, shares up 7.4%.
What actually drove a number that clean?
SpaceX mostly. The June IPO raised $86 billion at a $1.77 trillion valuation, the largest listing ever, and it supercharged underwriting fees across the whole street. JP Morgan rode the same wave, $6.14 a share against $5.85 expected, revenue of $58 billion against $50 expected, up about 2%.
And yet Citigroup and Wells Fargo both fell, despite beating just as comfortably. Citi posted $3.15 a share against roughly $2.74 expected, a 15% beat, on its best revenue quarter in a decade, $24.8 billion, and announced a $30 billion buyback on top of it. Stock fell 5% anyway because management said they pull forward job cuts and tech spending, meaning the costs show up before the efficiency does.
Wells Fargo beat $2 a share against $1.72 expected, 25% EPS growth, and still fell 3.33% on CEO Charlie Sharp's cautious tone.
So the theme from Chicks repeats here almost exactly.
Almost word for word. The market's pricing the next 2 quarters, not the one that just happened. And a 15% beat can still get sold if the forward commentary doesn't clear the bar. Jamie Dimon actually captured both sides of it on JP Morgan's call. He disclosed AI's already let the bank cut headcount by up to 40% in some units, then turned around and told analysts not to expect AI to meaningfully lower the bank's cost base soon, because every competitor's adopting the same tools and competing away any one firm's edge.
Which spine that's Dimon hedging his own good news, and I still think the efficiency story is underpriced across the group, but I'll grant the pattern's real. Boring stories got boring reactions this week. Dramatic stories got punished regardless of which direction the drama pointed.
One name to the opposite of that pattern, though, and it was the best single stock move in the entire S&P.
United Health. Adjusted earnings of $6.38 a share against a street estimate closer to $4.90 TILs, roughly a 30% beat, and the stock jumped as much as 8.7%. Second straight quarter they've raised full-year guidance.
On a stock that spent a year and a half in the penalty box after last year's cost blow-up.
Which is exactly why I'm not fully sold on the durability yet. The medical care ratio improved to 86.7% from 89.4% a year ago. Plain terms, that's the share of premium dollars they pay back out in claims. But a big chunk of that came from walking away from about 1.1 million unprofitable Medicare Advantage members and roughly 500,000 ACA exchange members. That's discipline, not demand. They got smaller on purpose, and next year's growth has to come from repricing the book they kept, not adding new premium dollars.
I'd still call it a real result. Optum, the services arm, grew earnings to $4 billion, margin up 160 basis points, serving over 120 million people. That's not just pruning, that's the other half of the company actually scaling. And Humana and CVS both traded up in sympathy, which tells you the market thinks it's a sector story, not a one-off.
One more thread that isn't finished yet, and it's the one carrying real stakes into next week.
PayPal. Reuters reported Stripe and Advent International jointly offered $53 billion, $60.50 a share, a 28% premium to take it private. Stock ripped up as much as 19-20% intraday, and roughly $50 billion of that offer is already committed bank financing, so it's not speculative.
And yet the stock traded well below the offer price all day because Michael Burry, whose fund holds PayPal as one of its largest positions, came out and called $60.50 simply too low, putting his own fair value range at $75 on the low end and up into the $110 to $115 area on the high end.
A stock trading at 9 times earnings before the news broke, and a value investor saying it's worth double the buyout price. That's not a rounding disagreement.
It's not, and it's why the stock's sitting in the high 50s instead of at 60.50 or at Burry's number. The market's pricing real deal risk, not disputing that PayPal's cheap. The board's expected to respond as soon as Monday.
We're not grading that one today. It's not resolved, but it's the single loudest thing still sitting open on the board heading into next week, and we'll be back on it the moment there's a real number. Last thread, and it's the one that got completely run over by everything else. Inflation actually cooled this week, and almost nobody's talking about it now.
June CPI came in at 3.5% year over year, down from 4.2% in May, well under the 3.8% the street expected, the sharpest monthly drop in headline inflation since April of 2020. Core was flat month over month, 0, below the 0.2 consensus wanted. PPI followed the next morning, also softer than expected.
On any normal week, that's an unambiguous rally in bonds and stocks both, full stop. And for about a day and a half, it was big tech hit records Wednesday on exactly that red.
And this was also the week the market got its first real look at the new Fed chair.
Kevin Warsh testified twice, House Financial Services Tuesday, Senate Banking Wednesday, his first appearances in the seat. His strategy, by every account, was to be boring on purpose, and it worked. Nobody's talking about what Warsh actually said this week. They're talking about tankers and TSMC.
which is genuinely a win for a new Fed chair walking into a room where roughly half the committee's already on record wanting another hike. Say nothing interesting, let the data and the geopolitics carry the news cycle instead of you.
So if the data cooled and the new Fed chair played it safe, why did yields end the week higher, not lower?
Because the oil shock overrode the disinflation story by Friday, exactly the way I argued it would Tuesday. I just had the wrong day. The 10-year pushed toward 457 by the close. The 30-year touched an 8-week high near 507, and the 2-year climbed to about 423, its highest since February of last year. A week that started with a genuinely soft inflation print ended with yields higher across the curve, because a physical supply shock in the Gulf matters more to bond traders than a backward-looking number on prices that already happened.
So your stagflation call from Tuesday, the one that lost, actually fired by Friday, just off a different trigger than the one you named.
That's a generous way to put it, and I appreciate you offering it, but I'm not taking the win. I said core CP. I would drive the 10-year through 465 that day, and it didn't. The mechanism I actually named was wrong, even if the destination the market eventually reached by Friday rhymes with what I was worried about. Being right for the wrong reason on a different day doesn't unlose a call.
I'll say it's the most honest thing said on this show all week, and I include myself in that comparison.
So pull the whole week together for me. What actually survived 5 days that started with a chip bear market brewing and ended with an oil war reshaping the yield curve?
The disinflation story survived technically, the print was real, but it got completely overpowered by a geopolitical shock that isn't going away on its own timeline, and that's the actual lesson. You can have genuinely good macro data and still end the week more nervous than you started it, if the thing driving headlines isn't the thing the data measures.
And underneath all of it, the AI trade took its first real gut check since the rally started. Not because the fundamentals broke, in my view, but because the market finally asked whether the spending converts into earnings on a timeline anyone can actually underwrite. That question doesn't get answered in one bad week. It also doesn't get answered by one TSMC beat.
That's the honest state of the board. Nothing here is fully settled, and I'd rather leave it that way than pretend Friday's close wrapped a bow on any of it. One thing carries into Monday specifically, and it's the loudest. PayPal's board responds to the Stripe bid as soon as Monday, with Burry's number sitting out there daring them to hold out. Everything else this week is graded, filed, and closed. If the show helped make sense of a genuinely chaotic 5 days, follow Nova Ventures Daily wherever you get your podcasts, and catch our daily charts and reels on Instagram at NovaVentures_US. That's the week. Graded. Eleanor's 4-4. Marcus is 3-7, and we'll see you Monday for the next round.